Oh shit.
Breaking news as UPS announces plans to lay off 20,000 of its staff and also plan on closing down several of their packaging facilities, signaling yet another sign of economic turmoil, which becomes even more clearer when we look at today's consumer sentiment report, which, you guys, is in the absolute gutter. Now, the American consumer obviously cannot afford to sustain our highly leveraged economy. Now, in addition to those two reports, we also have breaking news out of the housing market as the Case-Shiller Index is signaling that 2025 could finally be the year of a housing market crash. Now, our final segment is going to be on the fact that the FDIC is just an illusion of safety and security, as we point out that they do not have anywhere close to enough money to insure our deposits in the event of a bank failure. Now, the really big question that will be asked and answered is history just repeating itself once again? And a welcome back to Real Estate Mindset. You guys already know this video is going to be absolutely bonkers. Mitch Vexler, how are you today?
Well, the market today has gone completely sideways. You may as well just get a pillow and go to sleep. Nothing is moving. Dow is up 200. Gold is just going sideways. Silver sideways. NASDAQ is sideways. There's just not much to do at the moment. Market's kind of waiting for some sort of news, but at the moment there isn't any. So,
well, there's one thing: be patient, right?
Yeah, 100%. Wait
for
the setup before you take the trade.
Yeah, absolutely. All right, let's jump right into the first report breaking this morning, which is the UPS layoffs. From Market Watch, titled "UPS to Cut 20,000 Jobs, Close Dozens of Buildings Due to Lower Amazon Volumes." Shares of United Parcel Services surged in early trading Tuesday. Isn't that insane? It's not surging now, but again, 20,000 layoffs. To me as a consumer, that's signaling there are massive problems within that company, and yet people pour into their stocks. I don't get it. It is what it is, but the delivery giant's earnings beat Wall Street expectations, which offset announced plans to cut 20,000 jobs. Unfortunately, you guys, if you work there, that is due this year as a result of Amazon's volume loss. Now, the company also said it would not update its full year outlook given the current macroeconomic uncertainty. The company had previously said it expected 2025 revenue of $89 billion. UPS said it began a network configuration that will lead to consolidations of its workforce and facilities in anticipation of the loss of volume from Amazon. That will include cutting about 20,000 jobs, or roughly 4% of its workforce. The company will close 73 leased and owned buildings by the end of the year. UPS said it expects total cost savings from its consolidations to hit $3.5 billion in 2025. Additional buildings may be closed as it continues to review its network. Now, due to its actions, UPS expects to record between $400 and $500 million in expenses, including building closures and employee severance benefits. The job cuts may also lead to remeasurement of its pension plan obligations, but UPS could not yet determine the impact. In addition to that, this report also came out again April 29th, titled "Consumer Confidence Sinks for Fifth Month in a Row to the Lowest Since Depth of the Pandemic." Yikes. The consumer confidence sank to 86 in April, the lowest level since the depth of the pandemic, the Consumer Confidence Board said on Tuesday. This is the fifth straight monthly decline. Now, economists polled by Wall Street Journal had forecasted the index to register between 87 in April from its initial March reading of 92.9. Now, I'm going to do something new today. I'm going to ask you guys as the viewers to answer 3 different questions. And if you guys choose to answer the questions, do me a favor, put number 1, number 2, or number 3. And my first question to you guys as the viewers, number 1. So remember, if you're going to answer it, put number 1 so I know it's pertaining to the number 1 question, and so does everyone else. Have you changed your spending habits in the last 2 to 3 years? And also let us know why or why not. My question for you, Mitch, is how does this situation demonstrate to us that mom and pop simply cannot sustain our highly leveraged economy?
Okay. So coincidentally, I was working on something earlier this morning. The US national debt in 1992, when Ross Perot Sr. was running for president, was $4 billion. That's in 1992, not all that long ago, okay? In 2025, $37 trillion. Now think about that for a second. So running a little bit of math, that's 9,250 times up since 1992. And then I said, okay, fine. What about the median home value? In 1992, the median home value was 100,000. If you said, which is nonsense, but let's just go with it, that it's 400,000 today, median home value. That's up 4 times. It's about the debt. I'm referring to the government. That's what the problem is. This is what these politicians have allowed to happen. So the answer to Travis's question is the debt load cannot be paid off. You're up 9,250 over and above 1992. There is no math, as I've said, on this planet to get that debt paid off. The politicians have destroyed the idea of fiat currency. It's not that fiat currency is bad. It's the manipulation of the currency to transfer the wealth from mom and pop to the banksters by not allowing those banks to go out of business. Every time the Treasury steps to the plate and prints money, they are counterfeiting. It's not backed by anything. They've blown the bubble to the point where it's not only not sustainable, it's going to blow. And that's why mom and pop can't compete against it. And when you say, well, we have money in the bank, the banks have the depositors' money, where Travis is headed is obviously the FDIC, and we'll get there in a second.
Are you guys starting to get it yet with the Federal Reserve and how they still our wages? I hope so, because it seems like that's all we're talking about these days, Mitch. So we're going to go into segment 2 now, a breaking story that just came out as well from Market Watch pertaining to the housing market. The title of this article that came out, again, April 29th today, is Home Price Growth Fizzles as Economic Uncertainty Weighs on Home Buyers. If you want to talk about methodology, Case-Shiller is a perfect example of that, meaning they don't use raw data. They use very selective data. But this is what this says. Home price growth in the 20 biggest U.S. metropolitan areas are losing steam as buyers exit the housing market in the face of persistent unaffordability, and that is also in the face of lowered interest rates. Home prices are growing much more slowly compared with the last few months. The S&P CoreLogic Case-Shiller 20-Citted Home Price Index rose 4.5% in February compared to a year ago. The Case-Shiller Index measures repeat sales data. It reflects a 3-month moving average and generally has a 2-month lag, which means, again, methodology. This section's titled Housing Market Hits a Big Roadblock in Early 2025. You guys remember we hit a big roadblock in the second half of 2022, which led to trackable deflation in the housing market. Well, guess what, you guys? That's happening sooner in 2025. This is what this says. What is normally the busiest season for the real estate market is turning out to be another bust. Sentiment is soaring. The Case-Shiller Index is typically backward looking, so it doesn't quite reflect the current mood. Another problem with methodology. And the mood or emotions among buyers and sellers as of April is one of uncertainty. People are worried about the future of the U.S. economy and about their investment portfolios due to stock market volatility. That's affecting their decision to buy now or to wait. The pullback in demand could hurt home sellers. Sellers are clearly contending, thank God, because this is the swinging of that pendulum that I've been telling you guys about. It took a little longer than I'd have wanted, because of the bailing out of the banks, bank term funding program, reverse repo market. But thank God we can clearly see it swinging now. So sellers are already contending with an increase in competition as more listings hit certain markets, not in New York, but pretty much every other market. Some homeowners are slashing prices as they struggle to sell their homes. Real estate giant Zillow reported in March that nearly 25% of all listings on their site have a price cut. Now, some sellers are definitely struggling, but it usually is tied to pricing or presentation. I'm going to tell you guys right now, it actually is both. It should only be pricing, right? It should only be pricing, but people are so emotional when it comes to buying a house that presentation, unfortunately, matters more than math for some people, but hopefully not you. If a property is outdated or overpriced, it lingers, but well-prepared homes that are priced right are still moving quickly, especially in stronger markets. Home sales in 2024 hit a 30-year low, which is lower than the global financial crisis. Wrap your mind around that. And 2025 is already shaping up to be another rough year for the housing market. Now, before I ask Mitch the question of what's the difference between the housing market in 2017 and current, I wanted to show you the growth of median sales prices. Okay, so you can kind of see after the global financial crisis right here, it kind of started getting a little bit bubbly. In the housing market, you see it going up, but it wasn't until about 2020 when it really, look at this, guys, got out of control. I mean, absolutely shocking, because we were already in this bubble right here, and then boom, a double bubble. You can actually make an argument it's a triple bubble. Although this graph right here, it doesn't show a triple bubble. This graph right here, it shows a double bubble. The first question that I have for the viewer, so number 2, if you answer this, put number 2 and then answer this question. And my question is do you want to buy a house right now? And if you do, explain why or why not. Now, Mitch, my question to you is can you kind of break down and explain the major differences in just 7 years ago, so about 2017 to right now? How has the housing market changed?
It's been fraudulently induced up 21.2 trillion roughly by virtue of pure overvaluation as a direct result of the fraud, from which in 2024 alone, in 1 year, they stole, and the CADs, school districts, 450 billion from mom and pop across the United States. So in essence, what's happened, the central appraisal districts have created a tax on inflation. It's the Federal Reserve, by virtue of the printing of the money between them and the US Treasury, that caused the inflation. Then, to support that inflation theory, the stripping of the equity of mom and pop, the central appraisal districts figured out, well, we can just tax the inflation. We'll just go ahead and bump the values and we'll take that money. Again, equity stripping of mom and pop. The difference now is that you've reached the point where the median household income cannot pay off the fraudulently created school district bonds. Therefore, you're at the tipping point. It must be reversed. The debts have to go. If you do not reverse it, you eliminate the debts, both at the federal level by virtue of the derivatives and at the state level with regard to the fraudulent school district bond debt. The system will crack, and it's cracking now. You're living it. You're seeing it. It's just playing out in slow motion. All these problems are linked, and they're going to compound, just like the interest compounds. They're directly correlated at this point. So the interest gets bigger, the bigger the problems that you start seeing, the bigger the cracks, until one day the system simply falls apart. Your purchasing power of your dollar is disintegrating right in front of you. You're seeing it, you're experiencing it. You go to the grocery store, this is what you can feel. You can see it, you can mathematically quantify it. Again, it's the debt. This is a global problem. And you're seeing it everywhere because our Federal Reserve exported their crap across the globe, and the other idiot politicians bought off on it. They're going to have to fix the fiat currency, and they're going to have to get rid of the debt. And if they don't, we will wake up one morning, what we've been through in 2007, 2008, literally will seem like a walk in the park.
The easy things to understand is that the price to earning ratio, so the actual cost of the house to how much money that you make, is way higher, like crazy higher. Well, it's as high as it's ever been, but much higher than 2017. And then when we talk about affordability, we have to look at the payment of the house into the income. So that's debt to income ratio. That's through the roof. All of that's easy to understand. But what you just said is what we're really hoping viewers are starting to understand and starting to wrap their minds around, which is the central appraisal districts, or CADs, have figured out to systemically tax the home inflation. Think about that, you guys. This whole thing is intertwined. Let's go now into our third segment and let's talk about the FDIC and bank bailouts. Now, the first thing I want to point out is how much in assets the FDIC actually has by taking a look at the 2024 annual report from the Federal Deposit Insurance Corporation. When we go to page 74, it tells us right here on the bottom, okay, what the total assets are. And this is in thousands. So right now, the FDIC, it sounds like a lot. It's a lot too. If you're in Hurricane Helene, this is a lot of money. But they're saying the FDIC right now has approximately gross assets of $147 billion. When we actually look at the total amount of deposits as of April 2025, it's not in the billions. It's $18.1 trillion in deposits. They don't have anywhere close to enough money to handle any type of bank bailouts. Now, here's our history lesson, okay? And Mitch is going to really tie this together at the end here, but I wanted to talk to, and this is from Mitch, about the long-term capital management. Long-term capital management LP was a highly leveraged hedge fund. In 1998, it received a $3.6 billion bailout. Did you guys know that? From a group of 14 banks, in a deal brokered and put together by the Federal Reserve Bank of New York. The LTCM was funded in 1994. LTCM was initially successful with annualized returns of around 21% in its first year, 43% in the second year, and 41% in the third year. Holy smokes. However, and there's a big, big however, none of that was real, because in 1999, it lost $4.6 billion in less than 4 months due to a combination, here it is, of high leverage and exposure to the 1997 Asian financial crisis and the 1998 Russian financial crisis. The master hedge fund, long-term capital portfolio LP, collapsed soon thereafter, leading to an agreement on September 23rd, 1998, among 14 financial institutions for a $3.65 billion recapitalization under the supervision of the Federal Reserve. The fund was liquidated and dissolved in early 2000s. So question number 3 for the viewers, okay? And again, write this below, number 3. Over the last 2 years, what have you done to prepare yourself to take advantage of deals of your dream? Or if you don't want deals of your dream, what have you guys done to protect yourself from a recession? Have you saved your money? Have you canceled your subscriptions? Let us know what you guys are doing to keep yourself safe. My question for you, Mitch Vexler, is history repeating itself once again?
100%. Long-term capital management failed due to third-party credit risk that the Federal Reserve didn't see. And isn't it interesting that the Federal Reserve never seems to see anything in advance and is 100% reactive? Well, we didn't see this coming, and we misunderstood the irrational exuberance of the banks. Okay, fantastic lines, wonderful sound bites, but it's irrefutable proof they're grossly incompetent. They exist, as I've said, for the sole benefit of keeping the banks in business on the backs of mom and pop. That game is over. The sooner people recognize it, the better. And to this point, as Travis was talking, I just came up with something. So the FDIC, with $147 billion allegedly worth of cash reserves, that could be cash and securities, let's call it $147 billion between friends. The deposits on hand are $18 trillion. That's your deposits, mom and pop. Okay, you got $147 billion divided by $18 trillion. That is decimal 82%, less than 1%. The FDIC cannot rescue 2 major banks going down, let alone a whole bunch of banks going down. They don't have the money. And then you could say, well, fine, then the Treasury will turn around, left hand, right hand, the Treasury will turn around, go print it. Again, we're right back to the Weimar Republic. So just for fun, US national debt plus unfunded liabilities between friends, let's call it 160 trillion. 147 billion divided by 160 trillion, 0.09%. You see the problem here? And then it gets worse, because then if you take 147 billion and divide it by the 600 trillion worth of derivatives, which is on top of the 160 trillion of unfunded liabilities and US national debt, it's insignificant. It's a speck in the ocean. It means nothing. The FDIC is completely useless. If you believe that the FDIC will rescue your deposits, you're wrong. The math doesn't stack. It comes from their own documents. And by the way, we've got probably the largest library ever assembled of all these documents, videos, history, articles. It's at mockingbirdproperties.com/DCAT. So if you're new to the website and new to Travis's videos, go and look at all that evidence. Go and look at commonsenslaw.org. Go through the videos that Travis has on his site. Those are 3 of the best repositories of information possibly assembled. And it all proves the same thing. The math is the math, the law is the law, and mom and pop are being lied to and their equity is being stripped. And these are irrefutable facts. To this date, not a single person, including anybody in the government, has been able to stand up and say, oh, well, Mitch, you got this number wrong, you got that number wrong. The point of the matter is we're not wrong because it's the government's own documents. So when you understand the debt load, and that's why I keep saying it's the debt, nothing else matters. Mom and pop cannot carry the debt that you politicians have allowed to occur. You've been doing it for decades, and we're at the end game. Our currency is going to devalue maybe further than it has. It's down 97%. It's going to continue. We will wake up one morning and find out, holy crap, we're in the middle of a full-blown depression. And it's not just the United States, it's global. China can't get rid of our treasuries fast enough. They don't want them, rightfully so, but they've got their own problems. They're not innocent in any of this. No country is. Germany, France, Ireland, they got debts up to their eyeballs. Well, Ireland, not so much, but London, absolutely. London is in worse shape than we are. So when you understand what's going on, it all comes back to the same thing. There is no money to cover off the debt. They have destroyed the notion of fiat currency. Fiat currency would be fine, but for the human intervention, the FDIC, Federal Reserve, need to be shut down. US Treasury, a good component of it needs to go. Everybody needs a treasury when you have a government. You have to have somebody telling the truth. Our treasury isn't telling the truth because they're co-conspirators along with the FDIC and along with the Federal Reserve. But absolutely, the Federal Reserve, chain the door shut. Stop the money printing. Deal with it.
Deal with it. Now, real quick, guys, just a quick summary on the 3 segments. So the first segment on UPS, that's a clear indication that the consumer is not doing well and that the consumer cannot sustain our extremely high cost of living and our extremely leveraged up economy. Segment 2 on Case-Shiller is showing us and demonstrating to us that home values got nowhere to go but down pretty much max capacity. Why is that? Once again, consumers cannot afford to sustain those home prices because it's not real. Segment number 3, we're possibly headed to a world depression. Now, don't worry, you guys, if you want to know what to do about it, go to any one of our videos, literally any one of our recent videos, and hit the description on that video and look at what's going to happen, you guys. You're going to see all of these links right here, multiple links that we've made for you. One of them is the Empowerment Center. It's right here, realestatemindset.org. All of our information is here. We have videos, courses, digital downloads. This is not good anymore. I got to take that down. And all of this stuff that you see on the screen here is free. But we also have a $10 Discord. If you want to be part of a community that is designed for people helping people, come here. We have several different channels, all with links: appraisal protests, property protests, criminal complaints, seniors in distress. Join our Discord. On top of that, if you want to be an even bigger part of eliminating property taxes, don't forget to go to Mitch's website, properties. And if you go to the DCAT section, you'll have the petition here, as well as a ton of evidence if you really want to fight these guys. And also don't forget this, in the description is the step-by-step criminal complaint that took me 7 minutes to complete on video. Last thing, I promise, comment below if you've learned something and tell us what it is. Now, other than that, guys, if you're out there investing in your life, yourself, real estate, the stock market, your pension, your 401k, whatever it is, because we're in an everything bubble, we wish you luck and we hope you win.